Welcome to the inaugural episode of Exits and Entrèes, where we help entrepreneurs make the most of their hard work and creativity by helping them plan and execute elegant exits and entrées. A question that I hear often, both from clients as well as respective ones, is, where is a good place to invest now? When I hear this question, I flip it and I say, how about we go from good to great? And if you want to know where a great place to invest is, you have to ask yourself, where am I most comfortable sticking out the hard parts? That is, doing a down round? What do you actually believe in? Because whatever it is, I can assure you, you will have ups and downs. And when you can find an investment that you are able to stick with when things go south, you have a, not good, but actually great, investment. All of us, and I do mean everyone, appreciates when they get their statements, or they see by some other means that their investments have increased in value. That's the easy part. Where we struggle is when our investments fluctuate down. This is when we get tested. Most individual investors fail not so much because they pick the wrong investment, they fail because they lack conviction. They have a hard time doing the down rounds right. Consider this study from Dalbar. In 2023, they did a study to illustrate what happens, and what you see is what we've known for many years, and that is, individual investors tend to bail at exactly the worst possible time. The history of the SEP may illustrate that one of the more important determinants of your success is being able to stay the course when the markets are adverse. Consider each of the following points. 1. It can be a feast or famine. When you look at this, we see that investing is kinda like a feast or famine situation. However, over the last 97 years, that is the period from 1926 through the end of the year 2022, which we just lived through, the SEP appreciated over that time, 73% of the time. It actually went up 73% of the time. If we think about those odds, the statistics may lead you to conclude that it's better to stay in than to time the market. There's always the old passage. What makes you money is time in the market, not timing the market. Number 2. History cannot, of course, perfectly predict the future. However, it may help us determine the historic tendencies that form, or should at least inform, best practices. Number 3. In order to receive an annual return of about 8% from the stock market, you will need to tolerate the following. Going down more than 20% every 6 years, to get the annual average return of 8%, you're going to have those periods where, like last year, Nasdaq dropped over 20%. You have to live through that to get to the good parts. Thinking about these points may help us cultivate the reservoir of understanding, which may help protect us from selling out when things get tough. Last year, the stock market, the bond market, in fact everything that you could consider putting money into, even real estate, declined. There were very few places to hide. Please take a look at this chart of all of the asset classes and their returns for the past 15 years. The chart demonstrates a few very important insights. Number 1. Having a well-diversified portfolio may help you avoid the extreme declines that can come with being in just one sector or one asset class in the market. Last year, for example, the worst performing asset class was US small cap, which was down over 26%. A well-diversified portfolio was down negative 15.5%. The second point that you might take from this is, often the very worst performing asset class in any year may actually be the one that does best the following year. In 2020, for example, the worst performing asset class was REITs Real Estate Investment Trust. The following year, going from 2020 to 2021, REITs were the best performing asset class. This chart illustrates the consequences of the most extreme negative that may come from owning an investment. There are 2 key takeaways from the chart. Number 1. The more your account, or asset, or investment declines, the more you have to make to recover your losses. For example, if your account fluctuates down 10%, it has to increase by 11% to get what you lost. Second point, the amount that you need to make when you lose money increases with the increase in loss. So for example, if your account or your investment drops by, say, 40%, the amount you need to make back, to get just to even, when you drop by 40%, is 67%. Diversification is profoundly important, especially in times like this when we have a very adverse investing environment. Elegant investments begin with excellent intentions, effected through very thoughtful plans, using investment as best practices. Stay tuned for each episode, as we go over those practices, and explore the ways in which you can use them to make the most of your very hard-earned capital, now and forever.